Hi, everybody. Stephen Mead here with Domicile Real Estate, where we are on a mission to help Californians become homeowners. So, one of the things we're talking about is this is our update, our market update for entry level home buyers or first time home buyers, depending on how you look at it. And, we've kind of noticed an interesting trend the last few weeks. A lot of our macro numbers are looking better for buyers, and yet out there in the field, it doesn't feel that way. And I wanted to kind of do a video along with our normal stats and talk about that just for a couple minutes. So we're going to jump into our stats and then we're going to kind of weave our explanation in as we go through the actual data. So if you'll just give me a second here, I can actually go ahead and get everything going here. Let me go back here. Let's get our screen share set up. And here we are. Let's go back to the beginning. All right. So the first thing I want to talk about is prices, right? And there's a couple of things that I think it's really important to understand about prices. First off is when we look at these pricing charts, when you look at anybody's pricing charts, what they are telling you is what the market did 4 to 6 weeks ago, because it is based on things that closed recently, which means that those deals were negotiated, right? That's when you actually set the price, when you negotiate the transaction, not when you close, weeks ago. And depending on how they're doing the measurement, it could be anywhere from 4 weeks ago to like 8 weeks ago. So when you look at these prices, understand that we are looking at what's already happened in the market, which is prices hit a peak here. They dropped a little bit. They were a little soft in both of our entry-level single-family home category and our entry-level condo category. Just as a reminder, these stats are for Los Angeles and Orange counties combined. I'm going to get into that. That's interesting in a second. And our entry-level home is a 3-bedroom, 2-bathroom, single-family detached home. And our entry-level condo is a 2-bedroom, 2-bath condominium or attached property. And you'll notice prices, though, started to kind of rebound a little bit here, depending on which category you're looking at. That's important because, this is telling us, like I said, this graph stops 4 to 6 weeks ago. Now, if you look through here at our total monthly payment, thanks to interest rates remaining low and, in fact, easing just a little bit, our market is very volatile, but we're still kind of right in that 3% range. Even with these price increases, we're still looking at prices that are, to be perfectly honest, these are still great prices in the grand scheme of things. We're looking to be about $400 or $500 higher, or like 10 or 15% higher than our 2018 numbers for our entry-level single-family home. And frankly, we're less than 10% higher on our entry-level condo. If you watched our Bubble Talk video, you'll notice that when you relate these to rents, right, we're not at all out in left field with these payments. In fact, the reality is housing payments for buying have really just kept pace with where housing payments for renting have gone. And actually, that's to me, that's a sign of a healthy market. That means people are behaving rationally. They are making the best choices for them. Now, as always, one of the fun things I do is we just point out how much income do you need to buy these properties. And again, this assumes no other debt, and it's based on great credit and 5% down, which I think is fairly realistic for a lot of entry-level home buyers. We are just under $100,000, or just under $98,000 here for entry-level single-family home buyer, and right about $75,000 here for our entry-level condo buyer. What I find fascinating is that these numbers really are not that much higher than we were back in 2018. And when you look at where inflation has gone since that time period, I think these numbers are pretty reasonable. So the great news is I think that affordability, notwithstanding the last couple of weeks, which we have seen prices have felt like they're accelerating. So I'm curious to see where that goes. But frankly, if we're going by our most recent close data, affordability is still really in a decent spot where we would expect it to be. So now I'm going to go over what I think is the big question, and I didn't mean to tease people. We've got a market that in a lot of ways, when we look at the numbers, feels like it should be better for buyers than it is. And really, I attribute that to two big things. So the first reason why our numbers say the market should feel better for buyers, but it doesn't, is what I call the trailing effect. Now, consumers and sellers alike, when they read the newspaper, what we generally find is that people, whatever perception people have of the market, it is generally 4 to 6 weeks old. So people are feeling like the market is like it was 4 or 6 weeks ago. And I think what that means is that people right now are in a little bit of a panic buying type feel, even though really the numbers suggest they shouldn't be, but they are. The second thing that I've noticed, and by the way, sellers fall under this category too, right? Sellers are pricing homes, especially in a lot of areas up in Los Angeles. They are pricing as if the sort of gang, the blockbuster March and April, as if those had just continued. They drew just a little dotted line and said we should be up here for prices. But one of the things that that we're finding, the second thing that I'm going to go into is that, and if you watch a regular video, we went over this too, is that we collect aggregate data for Los Angeles and Orange County really across pretty broad price categories. And whenever you have a market that is changing or doing something, you find that not all market segments and not all price ranges and geographical areas move at the same time or at the same pace. So you might find, for example, that in the Valley, and I can tell you this, in the Valley, single family homes under $1 million are sitting longer. And I think the big reason for that is you have sellers who have just completely mispriced houses. They said the last guy got 800, I'm going to price it 900 and see what happens. And guess what? Buyers aren't having it. The demand isn't there to pay $100,000 over the last sale. It's just not like that anymore. But then you look at an area like Orange County and you look at sort of what I call premium townhomes. So these are a little bit bigger, 3-bedroom, great areas. That market is still very much on fire and has limited inventory, right? This is a lot of people who were looking at single family homes and they can no longer afford those. So, these different market segments are not moving at the same speed. So our market statistics are looking at an aggregate, right, across a wide geographical area and frankly across a pretty wide price range. 3-bedroom, 2-bath homes in LA County, LA and Orange County encompass a very wide range. There are homes in Lancaster for, gosh, I don't know, 400,000 probably. That's not a market we know really well. All the way to homes in Culver City, 3-bedroom, 2-bath might be $1.5 million. So, understand that we're across, even by doing what we call our quartile pricing, which is that kind of, we're at that first 25% of the market. If we went from the cheapest one to the most expensive, we're a quarter of the way from the bottom. Even doing that, we're really kind of going across a wide variety of areas. So I want to impress upon people, this is one of those moments where if you're going to lean on your agent who has experience, where you want somebody who knows how to understand the market dynamics of the market you are shopping in, not necessarily these aggregate statistics, which I think give us a good idea of where the market is going, but they may not necessarily be reflective of the exact market you are buying in. So, okay, now I'm off my soapbox. Let's jump back in and talk about the availability of pricing and sort of what some of these big macro numbers are that we're seeing that say we're in a market that is not as competitive. So where we left off, we were talking about minimum income. So here's our absorption rate. And this is really kind of our quick and dirty, how competitive is the market? And, if we look at this, I think really we want to look at this historically. Where were we, right, in March, April, end of February? Look at where we were for entry-level single-family homes. 100% absorption rate, 93, 88, 89, 91, 91. We were in the high 80s, 90s market. Look where we are now. Now, we did drop to 80%, which was really a low point. We bounced up off of that at 83%. And this is still a very competitive market, right? This is still a strong seller's market, but it isn't quite the circus that we saw earlier in the year. Earlier in the year, we saw buyers just wildly outnumbered sellers. And you saw that in these statistics. Buyers were buying up anything and everything. And that's not quite true anymore, at least across all of Los Angeles and Orange counties. Again, your market segment and geography may be different. If we look here at our condo market, was in the high 80s and 90s. It dipped into the 70s, and now we're kind of in this high 70s figure. Still a strong seller's market, but not a hyper competitive market when we go across all of Los Angeles and Orange counties. Now, if we look at our total inventory, I think this one really tells a bit of a fascinating story. Our blue line here is our entry-level single-family homes. And look what happened. Inventory just took a dive. And we were down here around 1,100 houses, I think, maybe 1,150 is sort of our low point. And we really sat around there for a while. And then towards the end of March, that inventory started creeping up. And actually, since May, we have seen some pretty big active inventory increases in this market segment. We are now over 1,500 houses available. That's almost a 50% improvement in inventory. Again, across Los Angeles and Orange counties. And sort of any of that 3-bedroom, 2-bath inventory. But if you contrast that with our condo inventory, and look what happened. It took a dive too. It wasn't as bad initially, but we've just chipped away at that condo inventory. It's gained a little bit, but really, it's kind of told a different story than that single family inventory. I actually think single family homes right now might be easier to buy at the entry level than condos. And that wasn't always true. Now, if you look at our 14-day still active, we have kind of some conflicting data here. And whenever you have conflicting data like this, where one indicator says the market's tightening, another indicator says the market's loosening up, really, that's a sign that a market is kind of hitting a little bit of an inflection point. It's a sign that things might be changing a little bit. So whenever I see that happening, when our indicators are not clear, to me, that makes me kind of stick my head up and say, this is not a market moving in unison. This is not a market where everything's moving in the same direction. Things are shifting and the ground is a little shaky. And I think that means pay attention, right? So if we look at this 14-day still active percent, higher is actually less competitive. And if you look, we're here in the 70s for our condos, and we've crept up for our entry-level single-family homes. Our condos remain pretty steady. I can tell you anecdotally in the field, I am seeing sellers make ridiculous requests of buyers, things like 0 contingencies at all, no ability to inspect, no ability to do anything. I don't feel like in our market that's a sustainable situation. I don't think that will last forever. And now if we look at our week supply of homes, I think this is kind of really an interesting way to look at it. And one of the things we've done here, right, is we've indexed this back to September of 2020, right? Because we kind of want a reference point. And one of the interesting things about week supply of homes is this just doesn't look at the total inventory available, but it looks at the speed with which houses are flying off the shelf. So it's saying, how long would it take to deplete our total inventory? And if you look at that here, back in September 2020, which feels like ages ago, right? Everybody thought that was a tight market, and then we got in the market we're in. So we had just under 4 weeks of inventory for our single family homes, and we had about 7.5 weeks of inventory in our condos. Look where we are today. Look at what's happened in the condo market. That has dropped to just over 5 weeks of inventory, but our situation with single family homes is much better. Yes, it's still lower than it was last fall, but I mean, at one point we were at almost 3.5 weeks. We were actually pretty close to last fall, and we've really seen this number steadily rise kind of over the last couple of months since the beginning of, maybe May, end of April. It's just fascinating to me because, the old logic, right? The old logic when you were looking at houses was that the condo market is always less competitive, right? That condo market always will have more things available. It's inherently less desirable. And what I'm wondering is, are we seeing market dynamics at play, right? Is this just because people can't buy the single families, they can't afford them any longer, so now they're looking at the condos? Or are we seeing a more permanent shift as our mix of housing changes? If you drive by any new housing developments throughout Southern California, I don't care what city you're in, you will be shocked to see that most of those developments are attached housing. They are not detached single family homes. And I think that should tell you something, that over time, our product mix is going to change. Our percentage of detached single family homes versus attached condos, that percentage is going to change. And is this really a sign that consumer demand is fundamentally shifting a little bit? Now that COVID appears to be mostly in the rearview mirror for people, I think that notion of I want to be by myself and I have to have a single family home, especially in urban areas, I think people might be kind of coming off of that a little bit. Now, the single family homes are certainly still more desirable, right? And prices have shown that. It's not that they're any less desirable, but I think what we're seeing is that, townhomes might have been the redheaded stepchild that nobody wants. Now the difference is everybody wants both. There's not single family homes are desirable, condos are undesirable. I think what we're seeing is they're both desirable price categories. And I think it's interesting to see just how competitive that condo market has gotten. Again, key takeaways here. I think we are at a point of inflection in our market. I think we're starting to see some of these numbers. When we see these indicators have conflicting results, one says the market's getting stiffer, another says it's getting easier. That's a sign that things might be changing a little bit. Second thing to understand is that our condo market and our single family home entry level markets, that relation between those two markets has changed. I think fundamentally, personally, I think that some of these changes are going to be permanent going forward for the reasons that I discussed. Finally, the takeaway that I want to make here is that your individual market when this market starts to change like this, not all areas respond the same. Not all market segments respond the same. So understanding what is happening in your individual market is super important. Okay, thanks everybody. That's all we got for you this week. Don't forget to like, subscribe, hit that notification bell. Once again, Stephen Mead here for Domicile Real Estate, where we are on a mission to help California's renters become homeowners. If that's you, you should talk to us. If there's anyone you know that you think shouldn't be a renter, they should be a homeowner, they deserve to be a homeowner, definitely send them our way. And if you're watching this on Facebook, do not forget to check out our YouTube channel so you can see all of our videos. Anyhow, thanks so much, everybody. We'll see you next week for our whole market update on Tuesday.